On this video, we're going to talk about how you can trade the Brent-Dubai contract, which is looking like a standout opportunity with OPEC meeting coming and potential for a lot more production, which is a big shift from the last 4 or 5 years. So I've got Harry and Tom here from Onyx Markets to talk through how we could do that if you wanted to put the trade on and how you can put it on with Onyx Markets. So first of all, Harry, I guess we put this idea to people in the podcasts earlier on, and of course in other podcasts. Just to go over it again, why do we think this is like a pretty decent layup at the moment?
Well, for the last however many years, we've been in a regime where Brent-Dubai has been kind of perpetually weak and weakening into expiry because you've had significant, well, not underproduction, but OPEC have been producing a lot less than their capacity.
Relative to the Western world, the US has been producing a hell of a lot more, which is more of the lighter stuff, Brent related, WTI related, and OPEC have been saying we're going to produce less and less and less. Even during the war, 2022, they actually cut again during that time period. So generally speaking, the proxy of cutting more versus producing more in the West is Brent-Dubai getting lower. So it completely has been logical why it's been weak. But I guess looking at the historicals, a normal level is what, $3, $4,
like
$5.
Plus $3, $4, $5,
And we've been down -1, kind of even -2 at the low end of this contract, kind of more in the prompt months. So now that we've got OPEC signaling that they are already bringing back some oil, and that kind of not quite pricing war levels between each other, but certainly Kazakhstan, UAE signaling they're not going to put up with these cuts anymore. They are going to come back online, and even Saudi are signaling that they're going to get going to too. So as we head towards the meeting, this could signal as much as 400,000 barrels per day extra coming online next month, and slowly unraveling back all the way. So a very clear trade would be to buy Brent-Dubai on this basis. Now, you don't want to be going and buying Brent-Dubai blindly, right? I mean, things can be priced in. That's the nature of financial markets. But we think this is a good opportunity because of just how low the differential still is, right?
Correct, and how the market has been positioned quite short. So,
as people unravel that short, as well as new entrants coming in, there's a lot of buy side momentum.
And that short positioning would have depressed prices a lot in the first place. We think it's still a good trade, whether it be prompt or if you're looking to trade a bit less volatility, something more deferred. But we're going to concentrate for now on relatively prompt the June contract.
Okay, so we're going to do June because basically the front month is always the most liquid, as in not the month that's expiring, but the one after that. So as of this second, that's May, but it's getting so close to where it's expiring. We want to move to June, which is probably the more safer way of doing it. Okay, so can we get the graph up for June on Flux then?
So here we go. So you can see it's rallied about $1 off the lows already.
Yeah, so from the 22nd of May, where it was lower about -120. Yeah, so we're up about $1.
Which is quite significant already, right? We're certainly on a bull trend. So if you were to be long this trade, we're certainly classifying the trade as a trending trade. I think that's fair. So classic trending tradecraft, Harry, for us in our training, we're looking at not being too cute here, right? We just want to be entering the trade kind of wherever we can get the liquidity off and a pretty decent wide stop to just ride it out. And we're not looking to say, splitting up our capital, giving multiple goes.
It's not a scaling.
It's not a scaling. Well, you could
unless it's scaling on the way up.
Exactly. It's put the risk on now that you intend and get that risk reward right from the beginning, because we think there's quite a long way to go, right? That's fair. So if we just say, if you were to trade the June contract and you're getting in around still negative levels around -29 is the fair value. So let's say -25 is where you could probably get your liquidity off as it stands, at least. So you're buying at that level. What would be an appropriate stop? We're looking for a target price, let's say, to begin with. Where do we think?
I mean, I suppose if you think that it's got legs to move up to, let's say, like $1 a barrel, plus $1 a barrel.
I think that's conservative, right? In a restructuring, you've got a pretty decent run, but because it's June, you've only got the month.
That's
of June,
what I was thinking. It's June, so I think targeting $3 or $4 might be a bit ambitious, but
that would be, if you did want to do that, you'd either keep the contract live and roll it as it gets closer to June, sell June, buy July, sell July, buy August, that kind of thing. Or you can buy
a deferred contract
like Q4, December, January, something like that. But let's just stick for June right now. So I think an appropriate stop, given it's trending, is we want it wide enough to ride out the noise. But really, if there's a sharp correction down too much, I mean, that's signaling we've got something wrong here, and maybe OPEC maybe they've made a big decision, and that was signal an exit. So where do we think an appropriate stop is right now?
Exactly. So a stop at around like minus 60 or like minus 60 cents, minus 65 cents maybe.
Yeah. So looking at the graph, we've got, I mean, just initially, just like eyeballing the graph, you can already tell like the kind of weekly volatility is around, it's moving up probably like 20 cents a week kind of thing. Or you can get a 7-day ATR, which we'll look at in a second, or a 90-day, 30-day standing deviation. But either way, just eyeballing, I would say like the resistance level kind of made maybe a week ago is kind of like minus 75, minus 80. And then that's when we started to have like these decent spikes, leveling off, spike again. So there's quite indicative of people stopping out, like basically stumbling over each other to get this off, which is kind of a good sign for the beginning of a like kind of breakout trend. But on the flip side, if we're going to really crash down and revisit these levels, minus 80, let's say, or certainly minus 80, but maybe even minus 60, something's going on there, right? That's what I'd be saying. At that level, it's like, well, can you verify what OPEC are doing? Have they actually cancelled their plans to bring back? Are they actually now cutting again? You want to get that level right where not only it's been said, but the price is signaling you're kind of wrong. So I think to be safe, given you're still in negative levels, you want to give yourself as much like room, so you've got a bit of a no-brainer trade on. So I would say that level kind of minus 65, I think will give you like a really good kind of initial stop level. If you wanted to be in this trade for a long time and buy a deferred contract, I would widen it even more, because then it's just going to give you that breathing room that makes you feel like you've got a great risk reward trade on for the long run. But given this is like a timing trade of, I would say around a month, because in a month's time, you're going to want to be taking off that June and buying something else to avoid it settling, and it being a bit more volatile. So that would be how I start. If we can look at the kind of dashboard we have, and firstly, the volatility. So yeah, this is the 30-day moving average, standard deviation rather. And so that's been increasing in the last 5 days, and which makes sense, right? We've started this kind of breakout, but we've got a way to go before it's been more historical norms, volatility even recently. So it's just all these signals are pretty decent indications of starting to trend and starting to break out. But if you're just going to use that metric of 30-day, we've got about 20 to 25 cents, or let's call it 25 cents. So, if you're buying at minus 20 and your stop is 65, 45 cents, you've got kind of at least 1.5 times the 30-day volatility as a stop, which is pretty good, right?
Which is decent. Yeah, especially for a one month trade.
Yeah. So okay. So that's the stop. That seems reasonable. A bit of a, gives you that breathing room. But then this is how we do things, right? So if you calculated your stop and you're comfortable with it and it makes sense, then you need to look at what your target level is and does that add up from a risk reward basis. So you said in a month's time, with OPEC meeting on Monday, and to ride this out for a month or so, it needs to be going up multiples of 35 cents. And is that possible? Do we think $1 is possible in the next month?
I would think so.
Yeah, I would think so too, right? Because it's flat historically is still super low. $1 is even quite low.
Yeah.
So
and in the last week, you've had a dollar move up basically in the last 10 days, like 7 to 10 days.
Yeah. If we go back to the dashboard and show the positioning, if we scroll up to the top of this one, so this is June, and we go to the open interest. I mean, the open interest is very high, right? We've got above trend. Way above the 5-year average, and above the getting very close to the kind of max levels you'd expect for this contract seasonally. Now, the reason why that's important is because we know, right, the market is short. I think we can confirm that if you scroll down.
So yeah, since inception, so you've got market short and getting shorter here, and then in terms of how risk's allocated.
So if there's a lot of risk in the market and the market's short, that's a hell of a lot of shorts to unwind itself. And that's what they look like they're doing now. That's got to keep unwinding. And, the confirmation of that would be the open interest going down whilst the price is going up. That would indicate the guys who are short are actually closing out the positions by buying. that would be good confirmation that you've got this trade kind of in the right way. On the flip side, you could see a lot of protection selling. It'd be pretty mad, but you do tend to sometimes see that. But generally speaking, the layout is, still decently skewed to a lot of people to buy back. So can that cause a dollar barrel move? Absolutely,
100%,
right?
yeah.
So if we've got minus 35 cents to make at least $1, that's 2.5 to 3 to 1 risk reward, more than enough. If you wanted to be really high conviction on this trade, good signals are obviously the OPEC meeting. If they announce that they're producing more than 400,000 barrels or confirm the 400,000 barrels per day, if you see the open interest kind of starting to level off and people buying, that's a great indication that people are stopping out and starting to move this. Those two signals are quite good indications to buy even more if you can get early in on the trend. And if you're looking at getting it below flat, that's I would say that's a pretty decent scaling level once you've got confirmation.
Yep, definitely. Yeah, like you said, especially if you get confirmation, you're pretty much looking for this OPEC announcement, aren't you, really?
Yeah, exactly.
And I think if you get that, then you might get that kind of hyperbolic move where you get stopping out, new risk entering the market, and like a genuine repricing.
Yeah. So I would say scaling is for the high conviction trader in this scenario, but it's a month, right? So I would probably tend to just say buying now, letting it breathe, and trading out of it once you kind of reach these target levels would be sensible. But if you wanted this really long-term trade, I think we'd have to go more deferred, like December.
Yeah.
Let's get up the December Brent-Dubai contracts. Right. So yeah, we've actually kind of been a little bit volatile this morning, but still exactly the same trend. If we look further out, so we'd look at December instead of June, that's a decent 6 months forward. This is what you expect, a lot less exaggerated version of the price action in the prompt. It's less volatile. That's the way the forward curve works. You get less volatility, you tend to have less volatility the further out, but it's also a long-term trade you can put on. So if you're going to put this one on and you're going to wait for this to play out on the next 5 to 6 months, this is like really trading a restructuring of the market.
This is where you could get your $3-4 a barrel move, because you could start to price in additional increases in production.
Absolutely. And given you expecting such a big move, we actually started the other way around and said the target price is like, let's say 350, which would be certainly a normal price and nothing too outrageous. It's been as high as 5 and 6 in bull markets, but let's say 350. We're still around flat. So what this allows you to do is just, again, all you need to do is eyeball the chart here and say, look, what are the absolute lows that we've seen in the recent past? Minus 15 cents, or let's just say minus 50 cents on December. You're well on the lows, right? I mean, you are very comfortably saying if this debt gets back down to minus 50,
I'm happy to be wrong.
Well, I'm happy to be wrong because something has to be wrong, because it's just very negative, so deferred out, which means the market has an incredibly high conviction.
Exactly.
That OPEC production is going to stay where it is and it's going to get even worse or even tighter.
And it already has been. If it was kind of not even pricing in that before, for it to get back down there is like.
Well, this is a great point. It's always about the state of the market and the price of the market the price relative to the state of the market. Yeah. So we've had peak bearish Brent-Dubai, right? You've had OPEC cut from 35 million barrels a day, and we'll get a graph up, down to 28-ish million barrels per day. And that's as low as it can be. It's like lowest since like 2010 or 2016, something around, 2010. And 2016 was the high, I think, at 34, around there. So the point is that, that is as much as they can feasibly cut before so much noise within the group, so many members wanting to bring back online. And you've got like sky high fuel cracks, sky high diesel cracks. Like it really can't get more priced in from a market state that like we're as bearish Brent-Dubai as you can be. So if that's the level with Brent-Dubai as weak as it is right now, minus 50, you are seriously wrong. Yeah. So you're really comfortable with that stop. And if it's 50 cents or even 55 cents from entry, or 60 cents from entry, let's just say, to be really conservative, you're at the bottom of this recent graph for sure, and you're just comfortable. But I mean, we could look at the volatility, but I almost think it's not necessary, right? You're putting this stop way below what you think's reasonable. So then you're looking at multiples of that. But we've just said, right, we think it's going to go up $3 potentially, $3.50.
Yeah. Which would be like a 6, 7, 8 times risk reward on your stop.
And that's just to begin with, right? Because I think if you're expecting that move to happen over the course of 5 months, let's say, you've got so many scaling opportunities, and you could probably be buying every dollar up to about $2 and then let it breathe for the last dollar, let's say, or you could stack all the buying in short-term increments to begin with, buying every 25 to 50 cents, multiples of the recent volatility. But either way, you've got some great scale-in opportunity. And every time you scale in, what you want to be doing is buying the next level. So let's say it goes up to plus 50 cents and you want to buy again. You buy 50 cents. And then what you want to be doing is using the gains made from your entry, which let's just say is, just to be conservative, plus 10 cents. It's around 4 at the moment. You buy 10, you make 40 cents. You reinvest that 40 cents. What does that mean? If you have an initial stop of, let's just say 55 cents and you've made 50 cents, you look at, let's say you've got $1,000. So you're risking $1,000 and then you've made roughly $1,000 on that move up to 50 cents. So instead of saying, I'm going to, risk more or anything like that, you keep the risk of, you were originally going to risk $1,000, you maintain still having $1,000, but you've got money, you're in the money. So you can reinvest what you've made plus the initial 1,000. And then when you scale in, you can adjust your stop accordingly. And now what you've got is still only risking $1,000, but you've got double the size on. So if your scaling is to buy double, then you've got double the size on. We're still risking $1,000, and we'll go over that in a little bit. And then you've just put in what I would call like a leverage scenario, right? So you're not risking any more than you intended to originally, but because you expect it to go on such a bull trend, you said you're looking at like, what was it, 8 to 1? You now make 16 to 1 if you can still get that kind of move, or at least 10 to 1. So this is how you get really standout returns on a huge long-term move like this. Okay, that's like the generic layup. Tom, let's talk about how we actually would put this on in Onyx Markets.
Okay, yeah, so I've just loaded up a chart of the June contract here, and we can see a deal ticket in the top left-hand corner. I've got the sell and the buy price there, and I've just entered a size of 30 100 barrel contracts. So that's the equivalent of 3 kb, 3,000 barrels of oil, because we want to risk roughly $1,000 on the trade. So we'd be risking $30 per cent movement, and we've got a stop roughly 30 cents lower. So that'd be about $900 approximately. And because we're bullish on the trade, I'm just going to click on buy here to execute the trade. And I hear that noise there. That tells me that the trade's been accepted.
Okay, great. So that's the overall summary. So just to go back over that again, we went through the process of starting with the stop and then giving a good idea of target. That gives us our risk reward. But the great thing about having that stop first is we can say, right, how much do we want to risk on this, right? The capital we want to risk on this is $1,000. We've just arbitrarily said that. But this is where the maths comes in, and we're going to have the trade calculator here, which is available. If you want to reach out to the guys, they'll give it to you in a conversation, a bilateral conversation. Just ask, just reach out, no charge, nothing. And we will get it on the website very soon. But anyway, the thinking here is, okay, I've got $1,000 I want to risk. We know it's a stop. This is the June contract where we said we wanted to buy around minus 30. And if we could, and either way, a 35 cent stop. And so if you know about the barrels and you know the dollar stop, sorry, you know how much money you want to risk, and you know the dollars per barrel stop, and you can use the two to calculate what your position size in, which you've just said. So again, it's going to be hard to get familiar for newcomers to begin with, but the tool should help with that, or ask the team. Professionals know all about this. There's going to be no problem. But either way, you've just said, assuming it's $1,000, you've just done the trade for, sorry, what was it? 335?
3,000 barrels. And with a stop 35 cents.
But you said 3,000 barrels, so that's 3 kb. But then you said in our increments, you're going to see it as well.
So we 30 100 lot contracts.
So each contract for us is 100 barrels.
Correct,
exactly.
Okay, fine. So it's 30 contracts. All right. So 3,000 kb. So you've got that on. And I think for the June contract, we've said if that's the way you're positioning it, you're just going to ride that, right? And hopefully look towards making $1. So again, Tom, how are we executing on the way up? Let's say we've got a target level of maybe half we're going to take off at a 2 to 1 return, so maybe 70 cents. Plus 65, plus 70 cents on the Brent-Dubai, and maybe another half at $1, something arbitrarily like that. How would we put that in place?
So there's a couple of different ways we could do it. So we could put a take profit, attach that to the position at the sort of final exit price, or we could also stagger a series of sell orders on the way up. So if you're wanting to do it in half your size, then you just put in a sell order of 15 lots at your desired level. So sorry, where did you say that was? Sort of about halfway of the
Well, if we've
move.
entered at minus 30 and you've got a 35-cent stop, looking at like at least 2-to-1 return, which would be, let's say, 70 cents. So actually it'd be like 40, but anywhere between, something around that, right? At the end of the day, these target levels are relatively arbitrary, but let's just say it's plus 50 cents for the first half and you run the winner for the rest. And it gets to the end of May, gets close to when the June start to expire. You want to basically have levels in mind where you're taking profit, and I guess a timing stop for when you close the trade out, which would probably be the last week of May if it was June. And that's hopefully pretty self-explanatory. Or you can just hack it and just go speak to Tom directly and he could talk it through you. But that would be the June contract. And then the December one, very similar, right? Just a longer
trade. Yeah, exactly. So I think in that scenario, I think we said that we'd probably be looking for a slightly wider stop. So you'd probably be looking for a slightly smaller position size. So if your stop's going to be, say, 50 cents lower rather than 30 or 35, then you're probably going to be reducing your size to 20 100-barrel contracts.
But because we said we're scaling in, that's where you're going to get like more bang for your buck. So again, we've got the calculator for this, but what you need to be calculating is your initial entry, your initial stop, like you just said, and then the scale-ins, they don't have to be double the size. They can be any multiple you like. But let's say you're adding the same size again and doubling the size over the of the entire trade. Then you want to pick the levels you're doing it. And given you're making money before you scale in, you want to do the maths of accounting for how much you've made plus your initial loss or drawdown allocation, and then that sum will give you your new stop. And that does get slightly more complicated. I think that's, if you're new to this, I'd very much look at the tool, but also speak to people, right, and get familiar with this. This is just to give you an introduction, and we'll do more and more of these. But again, ask for help, and that's the way to do it. So if you're in the December, you're scaling in, I guess the nuance is there about like, you don't want to keep scaling in forever, right? Because the more you're buying as the thing goes up, the more the kind of probability is
and your average price is getting higher as well. But if you're confident in the move, then you want to be looking to scale in kind of on like early indications that like it's a move that's going to happen.
Yeah, I would say generally speaking, if your target's 350, but it's got very high conviction, say above 2, then you want to be getting your scale-ins done kind of below 150 and then letting it breathe after that, because the further it goes up, the more you're going to get a market that has switched from a short to long. And at that point, I'd expect the market to be certainly more balanced and maybe long. So a lot of that initial price action is kind of stopping out and unraveling. And now you're going to get a more orderly build up. But the more people are the same way as you, the more you're going to be getting saturation and the more volatility. So if you've got to let it breathe at some point, otherwise when you scale in, you're buying and it could, gap back down and it's going to destroy your risk reward.
Yeah, I was going to say, you don't want to have too tight a stop as it gets towards your target level, because like you say, if the market starts to get slightly more saturated long, that's when you don't really get these like straight line moves up. It starts to be volatile. And if you're running a really tight stop, you're going to have to ride out a bit of noise to kind of, expect it to kind of grind higher rather than just gap higher, basically.
Yeah, perfect. And again, the biggest risk we have as traders is ourselves, in that, you need to be cutting your winners. If we say a stop, or you say to yourself a stop, you've got to stick to it, right? It hits that stop, you get out. You don't discuss, you don't go through the 5 stages of bargaining. Oh, if it just goes up a bit more, then I'll do it.
Yeah.
You don't get angry. You don't, start blaming Onyx, blaming other people, whatever. I mean, the amount of things I've heard people say, this is all part of the process of trading and risk management. These are things that are going to happen as you lose money. What is the way to protect against it? Stick to your system. And building a trade craft like we just have, a trade structure like we just have, is great only if you stick to it. And again, that's what the guys are here for. That's what you have brokers for, right? Hold you accountable, help you do this, get your plan in and stick to it, and that's it. And then on the flip side, if you're well in the money and you're doing well, the temptation is to be like, take profit, because you just want to see that money. But if you do that too often, you've basically just completely skewed your risk reward. You've done all the work to give yourself a great profile. If you don't let it breathe and play out, and you're cutting your winners, what you're doing is you're risking this much and making a small amount. you've reversed the risk reward from risking 1 to make 3, 4, sometimes even 8 if you do the long-term trade, to suddenly 1 to 0.5. And you should never do a trade for less than 1.5 to 1, and probably 2 to 1 is the one you should be looking for at least. So just remember that. But this is not a beginner's thing. This is what professionals do. Everyone falls foul to these kind of things. It's just our human brain. It's just what happens, which is why you need to try your best to stick to systems. So that was an introduction to Onyx Markets trading these kind of niche global oil contracts. We think it's a great reflection of what's going on in OPEC. Should you want a trade to reflect what's going on, Brent-Dubai by far and away is a great setup in general there, but the risk reward looks great and all that. But again, this is just ideas. No one's trying to force anyone to do anything. And thanks, Tom, for talking through kind of more the nuances of actually how to do it. So that's Onyx Markets. Go and check it out, onyxmarkets.co.uk. Flux was also the graphs that we're using to be all pretty, the technicals, looking at things. That is on flux.live. You will get the Flux subscription if you have a trading account on Onyx Markets. If you just want the Flux nice, sexy graphs and fair value we've got from Onyx, you can get that separately as a subscription. But either way, that was just our first go at this. We'll be doing plenty more. I hope you enjoyed. See you again soon, and be sure to check out the rest of our videos and podcasts. Thanks.